Hi everyone. Hi everyone. Good morning.
Good morning, sir.
Good morning, Archana. Good morning, Alex. Good morning, Raman, Ronim, Surup. Good morning, everyone.
Good morning, sir.
Good morning, Surup. Okay. I hope you all are doing great. So today, for today's session, what we are going to do is that first of all, let me solve one question till the time our other friends will also join. Let us solve one question and then we'll do attendance and we'll move on with content. We'll complete our conceptual portion of this chapter as well. And we will be solving many questions in the next class. Now, if you have any gaps in your learning, it is the right time to ask if you do not understand anything, okay? While we solve problem. Okay, so let me share you my screen. Perfect. So it is visible, right? Is it properly visible?
Yes, sir, it's visible.
Okay. Okay, thank you, Praveen. Okay, let us solve this one. And I'll again try to solve it through a very basic foundation. And if you have any query regarding any point, please let me know instantly. Yeah, okay. So let me start. This question is of operating leverage and break-even analysis. And it also touches a lot of concept of finance. So let me start. Oland Electronics Inc. produces stereo component that sells at the price of 100 per unit. Yeah, some of sorry, some of the bright ones. What you can do is you can solve this question on your own along with me. Okay, some of you also can do mind calculations. So this is selling price. Poland Electronics Inc. produces stereo components that sell at price is equal to $100 per unit. So we are given price per unit, that is $100 of product, stereo product, that is stereo component. Poland's fixed cost are 200,000. So we have been given fixed cost, right? Fixed cost. As you are given things in the question, you start to write it down, so it will be easier for you to answer it. Sorry. 200,000. Okay. So variable costs are 50 per unit. So we have variable cost. How much? $50 per unit. $50 per unit. And 5,000 components are produced and sold each year. So a number of units sold and produced. How much? 5,000. Right. EBIT is currently 50,000. So we have been given earning as well. Our EBIT is $50,000. 50,000. And Olin's assets are 500,000 assets. How much are assets? They have invested around 500,000. 500,000. Olin's can change its production process by adding 400,000 to assets and 50,000 to fixed asset operating cost. This change would reduce variable cost per unit to 10 and increase output by 2,000 units, but the sales price on all units would have to be lowered to 695 to permit sales of additional output. Now we have been given another condition, right? What would happen, right? Or given that this is the situation, but what would happen if we would do this. So that means that that is second part of the question. So let us fill the details a little bit on the sideways. Let us see. Olins can change its production process by adding 400,000 assets. So what is the additional assets? How much is the additional assets? 4 lakhs, right? 400,000, right? Additional assets. So how much is additional fixed operating cost? It's 50,000. So additional fixed cost 50,000. This change would reduce variable cost per unit by 10. So our variable cost would reduce by 10. What does it reduce by 10 means? What would be the variable cost for this one? Variable cost will be 50. Here is 50, right? The previous variable cost is 50, and as you'll reduce 10 from 50, here is 50, and we have been given 10 in the diagram. So sorry, in the question. So how much would be the variable cost? 50 minus 10 would be 40. Increase output by 2,000 units. How much? What is the additional? How much is the additional units? 2,000, right? But the sale price on all the units should have to be lower to increase the amount of sales. To increase amount of sales, to increase the market size, you have to take measures like reducing your sales price. So how much would be the sales price? Sales price has to be reduced to $295, not by, but $295. And to permit sales of additional output, Orange has tax loss carry forward that cause its tax rate to be 0. Now, how much is tax rate? It's 0. Now, why it's 0? Because it already has incurred loss in the previous year. So, for an example, let us assume for the year, if there is a company, for this company itself, for Olins, if in the year 2077-78, right, this is the year which just went by, 77-78, profit and loss, if it has incurred a loss of around maybe 500,000, and 2078-79, if in the case of 77-79, it has earned profit of 2 lakhs, what happens is that for the year 2078-79, how much would be the tax in this year? Nil. Why? Because it's in loss. So you only have to pay tax when you are in profit, right? That is called income tax, isn't it? So if you do not have income, so there is no need to pay tax. Profit, then there is no need to pay tax. And in 78-79, what happened? You had profit. So do you want to like directly add 25% to these 200,000? 25% being corporate tax rate of our country. So we are assuming this example so that you would understand the tax rate in this question. So 200,000 was profit and loss for this year. So if you multiply simply 200,000 with 25%, then we get 50,000. So is it our tax for this year? No. Why? Because what you can do in tax is that you can carry down your losses. Okay. So you carry down this previous year loss, and then what will be the remaining amount? 3 lakhs carry forward. Now this is something you can carry forward. Now until or till the time this figure becomes positive, you do not need to pay your taxes. So like these calculation runs in lot of companies like hydropower, because they incur huge amount of loss in the previous times. I mean restaurants as well. These restaurants also have usually until their point of operation, they usually have incurred a lot of losses, right? But before commencement of business, they do not. Usually, there is two way of displaying in balance sheets. One is either showing in capital work in progress or showing as loss. So it depends, but still, whenever the projects are running before commencement of business, usually they incur loss. And what do? They set up these losses for certain period. So there is a saying in business like loss is also our asset. Why? Because it saves our taxes. But you cannot say that theoretically. But in business wise, it is considered that way. Okay, so till the time your loss will be covered, you do not have to pay tax. So this was the same case. I hope you understood this concept. If you do not, then please let me know. Okay, so in this question as well, what has it written? Poland has tax loss carry forward that caused its tax rate to be 0. What happened? It also had loss carry forward like this, 500,000, and which led its profit to be 0. So as its profit was 0 due to previous year loss, so it need not have to pay any tax. That caused its tax rate to be 0. So it uses no debt and its average cost of capital is 10%. So what is the case in this scenario? It's 100% equity, right? No any debt, no any interest. Out of these all assets, it is totally funded by equity. And its average cost of capital is, how much is its cost of capital? Cost of capital 10%. So our first question, should Oland make the change? Why or why not? So how do we calculate this? So we have to find whether the change is profitable or not. So to find change is profitable or not, what do? We calculate return on investment, isn't it? Our formula to calculate is, or metrics which we should calculate is return on investment. So let us see the circumstance. Let us see what happens if this change happens, right? If we are supposed to change this, right? Do we want to continue this or not? So let's solve it. So how do we do it? First of all, our old new earning before interest and tax, how much was our new earning before interest and tax? New, how do we calculate? Our sales price was $95, right? So what is earning before interest and tax? EBIT means sales minus variable cost minus fixed cost. This is something we all know, right? So all things are given in the question, simple. We just have to put our inputs. So you can see here, our sales means quantity into price. So what is the quantity? 7,000. What is our new quantity? 5,000 and 2,000. We need to, new quantity would be our 7,000. Total units would be 2,000 plus 5,000, right? Total units 7,000. So if you multiply 7,000 with the price, selling price 95, then you get your sales. Minus F2 means fixed cost. What is the fixed cost? In the current case, 2 lakhs was something which you had to incur anyway, and 50,000 was the additional one. So your total fixed cost is 2 lakhs 50,000. What would be variable cost? Variable cost which had already been reduced. So 40 into number of units is 7,000 is the number of units. So this is our new earning before interest and tax, 1,35,000, and determine the incremental EBIT. To find the incremental return, we are trying to find incremental return to find whether it's profitable or not. To find incremental return, we need incremental EBIT. If we opt this option, what does it mean? If we opt this option, then how much additional earning we are going to generate? That is something which we are going to find from this thing. So our change in EBIT, delta means change. Delta EBIT is equal to 1,35,000. That is already calculated above, and EBIT is already given to us, that is 50,000 in the first case. So if we subtract 50,000 from 135, we get our answer, $85,000. I hope it's clear up to now. So after 3, I'll be asking you a question if you have any confusion. Estimate now again return on assets, ROA, return on assets or return on investment, whatever the name you can call. Why? Because in this case, your investment or asset is same, right? It's 5 lakhs in the first case. So additional, how much is the additional one? Additional investment is 4 lakhs, right? Return on assets or return on investment in this case. So if you calculate ROA, return on asset, is equal to EBIT divided by assets. Formula is delta ROA is equal to earning before interest and tax, that is earning return. The name itself, return on assets, return means EBIT divided by investment on assets, or you can write assets as well. Got it? So what is the change in EBIT? 85,000. What is the change in number of units? Change in unit is 400,000. So your change in ROE comes as 21.25%. Okay. So what is the cost of capital? Would you invest in this project or not? What is the answer? Should Olend make the change? Why or why not? You are investing in something. You are investing in something and you are getting return of 21.25%. But your cost of excess of fund, or to generate this $400,000, you have to pay 10%. That is the cost of capital. So the differential amount of 11.25, how much? 21.25 minus 10. It plainly seems that you have a differential amount of 11.25 as a marginal profit. So what do you do? You definitely accept this project because it's way above our cost of capital. Now I already mentioned you that as you are going to invest in certain assets, what happens? There is two things: one, source of fund, another is application of fund. Source, either debt or equity. In this case, there was no debt at all, right? No debt. No debt. So we had to generate from generate equity, right? We had to generate equity. And in terms of application, you have to do either expenditure. You want to spend that money on certain things, or do you want to purchase some assets? So in this question, we want to purchase assets worth of $400,000. So you have to purchase assets worth of 400,000. Now what is the cost of capital for that in the market? For that, cost of capital is 10%. So you have to, as a source, you have to generate that money from somewhere, right? To generate that, your particular cost is 10%. Now this 400,000, how much it generates? You profit of 21 point, how much? 21.25, right? So it's simple. You are getting fund from somewhere 400,000 at a cost of 10, right? As a source, right? You are, again, I want to repeat, you are generating fund of 400,000 from somewhere at a cost of 10%, and you are applying that somewhere. You are applying that in assets, and you are investing there, and you are getting return of 21. So definitely you will accept the project. Okay, so any confusion yet in this first question? Any confusion, please let me know. I'm waiting for your answer.
No, sir, you can proceed.
Okay, thank you, Praveen. Okay, number B, wood oilants. Now this is very interesting. This is something we learned in previous slides. Would oilants break-even point increase or decrease if it made the change? This is very, very important concept in practical life as well. So yesterday I had one client who used to run cake shop, right? and he was asking me, so can you please see how my business is going and all. What I did, I quickly um, talked with him, and I found out his break-even point. I told him that if you sell 600 cakes for a month, then you will be in your break even. That means that you have to sell 600 by hook or by crook anyway to run this business. Otherwise, it will be difficult for you. After 601 cake only, you are going to generate profit. That was really insightful for him. Likewise, this break-even concept is really, really important. Let us see in this case as well. Would Olin's break-even point increase or decrease if it meets the change? So let us find break-even. What is the formula of break-even? Break-even means fixed cost, how much profit needs sale price per unit minus variable cost. So it simply means that how much uh, extra unit we want to sell to cover this fixed cost, right? Okay. So simply, what is the old in the question we have been asked? Would Olin's break-even point increase or decrease? So how do we find increase or decrease? We have to find both cases, break-even for both cases, for the past one and the additional one. Only then we can compare between them and understand whether it's increment or decrement. So how do we find fixed F means fixed cost, that is 200,000. Here you can see, and you divide it by price. Price is already given 100 and variable cost is 50. Simply we can find our break even is 4,000 units. Second case, fixed cost has been added from 200,000 to 50,000. So our new fixed cost is 250,000, and you divide it by we had to reduce 5 rupees from sales, so that is 95 minus we also had to reduce as per economy of scale. As our sales unit is increasing, so our variable cost also reduced to 40. So our new break-even unit is 4,545. So in the first case, or in the old case, what used to happen? We had to sell 4,000 unit anyway. In the additional point, if we invest furthermore 400,000, then we have to sell 45 unit anyway, right? That is break even. From 4,546th unit only, this company is going to generate profit if we go for additional condition. I hope it's clear. Very simple concept. Final. Suppose Olind was unable to raise additional equity financing and had to borrow 400,000 at an interest rate of 10%. Now we have been given the condition. Up to now we have been given in the question that we only have equity financing option. Now we have debt financing as well. What it is telling us? Suppose Olind was unable to raise additional equity financing. What does it mean? It means that maybe share price of Olind in stock market is undervalued, right? Or it is difficult for market is in maybe recession, or people are not trusting companies, or new investors are not taking Olind's shares highly. So that is why Olind is not able to raise additional equity financing. And now it had to borrow 400,000 at an interest rate of 10% to make investment. Now it is from debt, it is generating 400,000 so that it could invest in new assets. So again, it's taking the interest rate at 10% to make that. So use the Dewpoint equation to find the expected ROA of the investment. Should Olind make the change if debt financing must be used? Explain. So I've been asked whether debt financing would be suited to the company or not. So that is our question. And there is something called Dewpoint equation. You might remember we discussed it in introduction of corporate finance in chapter of ratio analysis. So if not, then also I'll explain again. Dewpoint is nothing but breakdown of equations. I repeat, Dewpoint equation is nothing but breakdown of equations. You'd find that shortly. Well, let's see whether it's feasible on the increment ROA as well or not. So let us find. Now using debt. Now what does Dewpoint means? ROA. we need to find the return on assets, right? ROA, return on assets. So what does ROA mean? Can I write? Okay. So can I write ROA is return divided by assets? Can I write it? Of course I can, right? It's simply return on assets, means return divided by assets. So what is return? Return means EBIT, right? I can also write EBIT divided by assets, correct? So now what can I do? Dewpoint equation means simply adding a few factors. For an example, what are we doing in this? We are simply dividing by sales and multiplying it by sales. If you cancel sales and sales, then you get 1, right? You get nothing. So it's simply I am dividing sales in numerator and again multiplying sales in numerator and dividing it in denominator, right? So what happens? Return divided by sales means it's return on sales, and sales by asset means asset turnover, right? How much turnover is there for the particular asset. So we have got two separate ratios if we add sales in denominator and numerator. So this is called Dewpoint, nothing but Dewpoint. If you want to break down again, so then it is also supported by Dewpoint. So Dewpoint is nothing but trying to play with ratios. Okay, there's a fancy name called Dewpoint, but yeah. So we have to find now EBIT, sales and sales by asset. So incremental ROA is equal to change in profit by sales, same formula, profit by sales and sales by assets. Increment in profit by increment in sales into increment in sales by increment in assets. We know all the metrics, but we need to find profit. So what is the profit? What was the new profit? 1,35,000, right? New EBIT was 1,35,000. It's already calculated. 50,000 was already old EBIT was given in question. Old is minus 50,000. But we know that we always deduce interest from profit, right? Interest from profit. We deduct it from profit because it is our expenditure. So when you multiply 400,000 with 0.1, right, then your change in profit would be given that we are taking 400,000 as in as a loan. So in that case, our change in profit would be 45,000. So simply put, change in sales is again 95 into 7,000 minus 100 means sales price into 5,000 old unit. So change in profit is change in sales is 1,65,000. So if you simply divide change in profit, that is 45, by 165 sales, and again sales by that additional amount of sales, then you get your answer 11.25. It is really close, 11.25% only return on assets. The return on new investment still exceeds the average cost of capital. Our average cost of capital is 10%, right? So 11% is still exceeding our cost of capital. What does it mean? We are generating 400,000 from as a loan, as a source, right? And we are applying it in the assets, right? In the assets of around 400,000. And to do that, we are getting our return back as 11.25%. So is it feasible or not to invest? Yes, it is definitely feasible because our return is exceeding, our return rate is exceeding cost of capital. So any confusion in this, please let me know. Did you understand this?
Yes, sir.
Thank you, Archana. Okay, so then since there are no confusion, let me move on to today's class. First of all, let us do attendance. Alex, present. Arjuna,
Present, sir.
present. Ashish, okay. Dipesh, perfect. Even, okay. Jeju, Jeju Rai, absent. Marina, present. Ninju, Ninju Thapa, present. Nishan, Nishan Shrestha, absent. Ojasvi, present. Prakriti, present. Prasamsa, present. Praveen, present. Raman, present. Ratnaprabha, Ratnaprabha Thaman, absent. Revision, present. Ritish, present. Rivaj, present. Ronim, present. Satyam, present. Salina, present. Sarisma, present. Shekhar, present. Smith, present. Swarup, Swarup, are you ready for revision?
Yes, sir.
Okay. Eunice, present. So I'll call the name of absentees. If you are there, please let me know. Jejurai, absent. Jejurai, absent. Nishan Shrestha, absent. Ratnaprabha Taman, okay. Ratna, absent. Sorry, present. So we have two absentees, Jeju and Nishan. 24 of us are present today. Perfect, 25 participants. Okay, so let me hand over the floor to Swarup. Swarup, you have got 1 to 5 minutes and you can reiterate what we learned in your own words.
Okay,
So over to you, Swarup. Swarup.
so we continued with the chapter unit number 6, capital structure and leverage, where we started off with the topic determining optimal structure. So an optimal structure capital eh, is the best mix of both debt and equity financing that maximizes a company's market value while minimizing its cost of capital. So at first, we were explained about the earning per share of ACE Education, and if its debt or capital ratio were to be maximized by the ratio of 50%, then the ideal optimal capital structure calls for debt would be 40% and not 50% debt, because earning per share increases with the increase of debt installation in the company, and it increases to a certain level only. Along with the addition of earning per share, risk also rises as we induce more debt or financial influence in the company. So as per my understanding, if earning per share is raised while we increase our debt portion from 40 to 50% because of the increase in risks, more than increase in earning per share, we might not want to increase the debt to 50%, therefore settling for just 40% only. And then we arrived at weighted average cost of capital, aka WACC, which shows the average rate the companies pay to finance their overall operation. So structure that maximizes the stock price also minimizes the working average cost of capital. And at times it is easier to predict how the capital structure will affect the WACC than the stock price. In the next slide, we were shown a schedule and a graph where there is an increase in the debt ratio, resulting in the increase of premium for financial cost as well. It is because we are taking more risks so that we gain more interest. As we start to increase our debt ratio, the amount we require from our equity must rise as well. So as the debt proportion is increasing, so does the required return as our risk of bankruptcy also increases. Now, in the next slide, we are shown the relation of weighted average cost of capital with the help of three examples. Where in the first, in order to find the ideal optimal structure, the weighted average cost of the capital is calculated in all the cases. In the second example showed when the debt ratio starts to increase, the WACC starts to decrease, and only at just one level it starts increasing. In the third example showed that whenever WACC decreases, our stock prices increases, and after become maximum, it starts declining. Moving on to the next slide, we are introduced to a new concept known as capital structure theory, where we started by talking about the most influential financial article to be ever written, which was published by Morton Miller. Because of the understanding of the article of the condition of what not to be approached or what not to do, it became the number one in the world, despite at first being the worst article to be ever written. Now, according to Morton Miller, whatever the debt equity ratio we choose doesn't matter if there is no brokerage cost, taxes, bankruptcy cost, and many more. After that, we ended the slide by talking about the importance of Morton Miller's irrelevant results, which declared that mistakes are important. And then we talked about the assumptions of the effect of tax. So this theory was criticized harshly at first, but later, after a few years, a new improved theory was later published. In tax effect, balance return on common stocks are lower than return on debt. For example, if some amount of money is saved from our income interest, then the equity holder will be benefited, and that's pretty much it. And then we have another assumption of capital structure theory known as the effect of potential bankruptcy. In this assumption, as debts are added more, bankruptcy changes also increases. There are lots of hidden cost in costs in bankruptcy. For example, if a company is about to be shut down, then lots of other customers will automatically follow like high legal and other accounting expenses, and retaining customer suppliers and employees will also be very difficult. And then we arrive at a new assumption known as the trade-off theory. So the trade-off theory is simply an idea that a company chooses on how much debt finance and how much equity finance to be used by balancing the cost and benefits. And then we finally concluded the session with windows of opportunity and another assumption of capital structure theory. So this is also.
Big round of applause for Swaroop. Wonderful job, Swaroop. Definitely a benchmark. Thank you so much. I'm utterly impressed by way you could articulate what did we learn in the last class. Wow, wonderful. It is not
Thank you,
only
sir.
benchmark for this section, it is benchmark for both the section. You know, I've been doing this session for both sections A and B, and you did wonderful job. Fantastic.
Thank you, sir.
Okay, so Swaroop, please nominate someone.
So can you please list out the names of the ones who have already done it?
Definitely. Let me send it. These are the names. Up to now, 13 of you.
So I think I'll go with Smith.
Smith, please accept your nomination. Yes, Smith. You are raising your hand. Please accept your nomination. Okay, perfect. Thank you, Smith. So again, I'm glad how you meticulously revised it, Swaroop. Wonderful job. So now let us move on to today's class. So we had, as Swarup told us, we discussed about capital structure theory, right? And it was one of the most influential theories which are there, and yeah, which are there, and some of the things which we learned were the last slide was this 25 number slide, and in it there was windows of opportunity, right? And to go back again, so this was the case of buyback when stock price was high, stock was undervalued in the market, then company would prefer buyback, and when stock price was high, then company would go for issuing new equity. So we start with this fresh slide, checklist and fresh concept, checklist for capital structure decisions. So what are the things we must keep in mind while taking capital structure decisions? So these are the checklist, right? And these are the things we must consider while doing it. So first one is sales stability. Sales stability, what does it mean? Sales stability means that how much stable our sales is, right? Our turnover, how much turnover is moving, or from the previous year, whether it's changing or not, we are getting that required amount of sales or not from the market. Our market size is good or not. So that things are really relevant for us to understand our sales stability as well. Why? Because as sales will be there, right? Sales has direct impact on EBIT, isn't it? As we understood that higher the sales, definitely higher would be our earning before interest and tax, and higher the earning before interest and tax, if we have enough space in earning in our profit, then we might want to add interest, right? We might want to add interest rather than equity. Why? Because we want to pay that specific amount, not that unlimited amount. But our sales is low, our usually sales is low, our performance is low, then usually we would want to raise our funds from equity. Why? Because maybe our performance is lower, and maybe from the market, if we want to purchase from the market, we have to pay that fixed amount of interest, isn't it? So if we pay 10%, then we have to pay 10. If we take money from debt holders, then we have to pay that fixed amount of money anyway. So bankruptcy threat or bankruptcy risk increases. So we have to pay this 10% anyway, or that fixed amount of interest. So maybe if our sales is low, then usually maybe we want to not go for our fixed portion or add more burden to our profit. Rather, we'll move on to equity investment. And why equity? Because equity holders do not demand any amount if we are in loss or if our performance is low. So that is one example. I try to break it down. Second, asset structure. What is our asset structure? Where we are investing, right? So from plant and machinery, right? From plant and machinery to new capital ventures, right? Capital budgeting decisions, new capital budgeting decisions, right? So whichever the venture comes up in our way, so we have to think about asset structure as well while considering it. Third, operating leverage, fixed cost, of course. How much is the fixed cost? According to the fixed cost, we'll definitely think about it. Why? Because higher the fixed cost, we would not want to add more burden to fixed cost. If we take debt financing, then more interest would be added to fixed cost. So if our if our operating leverage is already high, so we would want to raise fund from equity, not from debt. So likewise, growth rate is another term. If we are starting firms, right? If we are growth-oriented companies, maybe we would want to check on which is the ideal capital structure, right? So usually when company are mature, yesterday in one slide I showed you that Google and these big companies like Amazon, they are already mature, isn't it? So as they are matured, their debt to equity ratio is unusually not for proper finance terms. What does it mean? It means that their equity portion is really high. Their equity portion is really high. That means there are less owners in these companies, and their internal income is enough to sustain them. Their internal income are enough to sustain them. So they usually do not raise any kind of equity, and they seldom raise any kind of interest as well, so any kind of debt as well. So in both cases, it definitely depends on growth rate. What kind of growth rate do you have? Are you a new company which has a huge amount of growth rate? Are you a mature company, you are already there in the peak? Or are you a company which are starting and are a newbies, right? If you are newbies, you definitely want to have a lot of new financing options. You definitely want to have IPOs, right? IPOs and all. You can see in Nepal as well, whenever company are established, you can see many IPOs coming up. For example, of hydropower companies, hydropower, right? Hydropower, after its completion of around 70 to 90% before commencement of business, it already raises its capital, okay, and it invites equity holders to it. So as I would say, hydropower are also in the phase of growth, so they would want to have funding from equity, so that they want to pay off their debt. They want to pay off their debt. Usually it happens that they usually raise equity so that they can pay off debt. There was a restriction by Nepal Hydro Development Authority as well, that whenever you raise new capital in the market, you cannot pay back your interest, pay back your interest from banks or debt, right? You cannot do that. It was a regulation, but I think it has been abolished. And one of the classic example is of Shivam. What did Shivam do was it raised its capital, right? IPO. It raised. There was an IPO of Shivam, and with that IPO, it raised its capital. And it paid its interest holder back, or debt holder back. Why did it do that? To increase its EBIT. So why to increase its EBIT? To increase its profit. Why to increase profit? To increase its performance and give more dividends. And if you give more dividends and you have better profit in the market, what happens? Share market goes up, right? So as share market goes up, the objective of management is complete, increasing the value of shares, right? So these were some of the steps which was taken by Shivam Cement regarding the growth. Next, profitability. If you have huge amount of profit, it doesn't matter if you take from debt. For example, you have billions of dollars in terms of profit, then why would you want to add equity? You never want to add equity unless you are in dire situation. So of course, if your profit is really high, you definitely want to add more debt, because it doesn't matter. Maybe if you add 10% debt, maybe you add 20% debt. If your profitability or EBIT is high, then usually you can pay interest easily. So no worry at all, right? So it depends on profitability. Next, taxes. So if we are in a country like Nepal where tax rates are really high, although our government claims that it is one of the most tax-friendly country in the world, so it was a joke as well back then. But yeah, coming back in terms of taxes, what happens is that if tax rates are usually high, right? If you start to calculate and you find that your projection is depicting you lot of taxes to be paid, then you usually add more interest to your financing methods, or you add more debt. Why? Because you want to reduce tax with interest. Why? Because I already told you, in that pie, first pie is taken by government, but it considers interest as well. It considers interest means after deducting interest, then only you have to pay interest to the government. So that is why if your taxes are high, you usually would want to raise money from debt, not from equity, other thing remaining constant. Okay, so next, control. For example, let us take an example. We have a shareholder in the company, Prasamsa, Prakriti, Ojaswi, and Praveen. Okay, they are the shareholders, and they have joint amount of around 51%. Now there is a new threat in their company. Yeah, you can see in movies as well, right? There is one aggressive investor that is called that is Rivaj. For example, Rivaj is aggressively coming in their company. It bought all the stakes from the market and it is raising its dominance in the market. Now he has already bought 25% shares, right? Now although they are unified, but they are threatened that Rivaj is trying to take over the company. How? If Rivaj gains around 51%, then he has everything to say for that company. In the board of directors, chairman would be of Rivaj. Major decision would be taken by Rivaj. So Prakriti, Prasamsa, Praveen, Ojasvi, they are already in threat. So their control, they are in agony that or fear that their control might shift off from their business, because that business was something they planted it, they had their dreams, they gave a lot of time and effort and blood and sweat, right? So they would want to save this company, right? So what do? They would not want to raise more equity in the market. Otherwise, what would happen? Rivaj is going to buy any equity which is going to come in the market from maybe secondary market or somewhere, anywhere. He is going to acquire those shares. So what happens is that it is the matter of control as well, whether you want to issue more equity or not. Okay, I hope you got it. Next, management attitudes. Like if management is like our parents usually tell us that, son, daughter, please don't take loans. Yeah, with these loans it will increase your tension and all. You are too young and all to take loans, and so don't take more tension and all. So we have this conservative approach. But if management is also conservative, like let's not take loan and all, right, definitely company will not take loan. So it depends on management attitude as well. So what is the preference of management, right? Everybody have their own biases and perceptions and way of thinking, right? So if management is pro debt or anti equity, right, or pro equity anti debt, so usually managements are anti debt, that day we understood that they would want to raise money from equity rather than, because they usually do not care about control, or they do not care about other matters, rather than they would love to have more spare cash in the business, so they could buy jet planes, they could have lavish offices, right, and all. But if their money, or if the free cash flows are connected, or they are brought together with interest, what happens? Free cash flow reduces, right, due to interest. And as there are less free cash flows, what happens? Management cannot do lavish expenditure. Management has to increase EBIT. Management has to pay more dividend to shareholders so that its share price goes up. So as interest increases, now pressure is with the management. So how to increase EBIT if interest has already been increased? Management has to increase sales, right? So how to increase sales? They have to work on it. They have to do marketing. They have to bring all the strategy together, right? So these kind of effect comes up with a lot of management attitudes and all. So next, lender and rating agency attitudes. What does it mean? Now we have different rating agencies like ICRA, right? One example is of ICRA, right? Or there is new one. What is its name? So recently of Onul Rajbhat, right? Okay, so there is one care, something care, NIP care or something. So there is another rating agency as well. So what do these rating agency do? When you have whenever new IPO comes up in the market, so that IPO is given to them. For example, if a new food product comes, right, whether it's safe for consumers to consume it or not, we have food department in place, although it doesn't work in Nepal much, but in outside countries maybe, definitely in outside countries, what do they do? Without approval or ISO or trademark of these health associations, no any consumer products can be circulated in the market. Likewise, without trademark of ICRA and ACARE or something, no any IPOs, FPOs or everything, because is it harmful to the investors or not? That is something investors must know. So how good it is, how fresh it is, how healthy it is for investors. These are the things which these ratings company helps investors to be aware of. So if you have rating of A, B, C, D, E, like that, right? So there are different kind of ratings, right? So according to those ratings, we can see whether these are healthy or not, correct? So like this, a lender and rating agency attitude. If ICRA and these kind of lender and agencies are very strict regarding FPO and IPO, then usually company would not go for issue of shares. Rather, they might want to opt for debt financing as a quick measure. Other thing remaining constant, of course. So this was another concept. 10th one, market conditions. One of the biggest factor, biggest players of our decision making. Why? Because today any company would want to issue IPO. Why? Because overnight people are becoming billionaires in Nepal right now. The equity holders of companies, they are earning huge amount of money, and you can see now this Manusi Lagu Vitta has also started floating its share, right? Before it, there was another hydropower company. Other three are in pipeline in this month itself, right? So many companies are coming to issue IPO. Why? Because share price in the market is greater than intrinsic value. Why? Share price in the market is greater than intrinsic value. Market is overvalued. People are interested in the market. So everyone are investing in the shares, regardless of number of units. It is oversubscribed 21 times, oversubscribed 24 times, oversubscribed by numerous folds, right? So companies are enjoying this particular time to raise funds. It should not be this easy for companies in outside world. It is very, very difficult unless company can prove it that their shares are wonderful, they have wonderful rating from ICRA or these kind of rating agencies, then only investor usually invest. Remember the times remember the times when the shares you bought in IPO, it was 100, right? But the price of that stock slumped to 60 or 80. Do you remember that? Especially a hydropower company. So if that was the case, you would not invest in hydropower, right? Because you are buying in 100 and you are getting market value of worth around 60, 80. So in that case, you would not want to invest in new shares. But what happened right now? Any hydropower company, the lowest one is in 390. Right now, lowest price of hydropower is 390 around, right? So any hydropower company can issue. From a hydropower company to any kind of microfinance or any kind of companies, they are issuing huge amount of IPOs and they are accessing fund from the market. So market conditions are really important, whether it be share market, whether it be debt market, right? Right now the interest rates are really low, right? Interest rates are really low, and it is also favorable condition for companies to buy or to go for loans as well, right? So both cases, it is right time for companies to invest in huge and big projects, right? So every hydro enthusiast, they are surging for developing new hydropower right now because they're getting cheap loans, they are getting great amount of money from or over subscriptions from equity market. So it is ideal condition for investors according to the market conditions. Got it? Next, firm's internal condition. I gave you an example of Google. They have such an immense amount of internal revenue, they do not need to raise any capital from anywhere. So their capital structure may be no debt, less equity, right? Or less debt, less equity. So it depends on firm's internal condition as well. So final one, financial flexibility. How much flexible? Financial flexibility means how much flexible company is, or how much risk appetite, or how much friendly the board is to tilt towards equity and debt, right? If there is a huge resistance, right? If there is a huge resistance from the management that let us not like change our way of raising capital, let us stick with one. So then that is kind of like a solid kind of approach, right? Solid kind of, or that is non-flexible kind of approach, which may work or may not work according to the company. So some companies might have flexible ones, like they want to raise equity from sometimes they want to raise from debt. Again, they want to internally generate some revenue, right? So it definitely depends on type of companies and their financial flexibility with board of directors, with their flexible in terms of income, their past history, and a lot of things follows. Okay, so these are the determinants, these are the checklist or capital structure decision makers or players, whatever you call it. These things are certain factors which determines whether we want to raise capital from debt or whether we want to raise capital from equity, or how much. Not whether, not 0 and 100, that is not the case. The case is how much debt, how much equity, when to purchase, when to raise, any kind, time, amount. It depends on intensity and how quick everything. A lot of decisions are caused by these enablers of capital structures. So any confusion in this slide, please let me know. I would love to clarify it. Or shall I move on to the next one?
No confusion, sir.
Okay, thank you, Archana. Let me move on then. Okay, with your go red green signal. So this one is next concept, variations in capital structure. Now again, I have been showing you practical examples what is happening around the world. This is such kind of interesting data as well, right? What kind of companies or the famous companies of the world, how much they have debt, what portion they have debt raised, right? So this is the slide for that. So wide variation in the use of financial leverage. Financial leverage means debt. Please do not forget it. Operating leverage means that fancy term, like somebody loves to call financial leverage rather than debt. Somebody loves to call operating leverage rather than fixed cost. So a wide variation in use of financial leverage occur across industries and among the individual firms in each industry. According to the industry, so you might want to open one, for an example, you might want to open one supermarket like Varpatini. So you might ask me, sir, what is the ideal or what is ideal optimal mix of debt and equity, right? So for that, I have to see your data, I have to calculate it. But you might ask me another question as well. Sir, how much Varpatini is doing? How much debt is Varpatini raising, or how much debt Walmart is raising? So likewise, I can get the hint what works best for supermarkets or what works best for grocery kind of business, right? Food business or supermarket business. So according to the sector, you would want to know, according to the industry, according to the company, you would want to know how much debt they are raising and all around. So let us see. So although in this slide, it seems a little bit cut down here, I will share you the full slide. I don't know what is the problem with it, but I will share it. Okay. So let us see recent research done by John Graham, Mark Leary, Michael Roberts traces average debt ratios of US companies over the past century. They did research for 100 years, and this is the result out of that experiment, out of that research. So let us see in terms of, first of all, let us see in terms of industry. Usually what happens in terms of industry, if the company is related with internet content, their debt is 2 and their equity is 98. Their debt is only 2% and their equity is 90%. It's in US, okay? These examples are of United States. Definitely, as you guys are international students, and we all know that we do not have proper research data in our country. So we usually take best example, and those definitely comes from US. And these companies are the ones which usually takes market all around the world, right? Facebook, Snapchat, Google, and these companies. So it would be easy for us to relate, take it as a benchmark, and to conceptually clear data, because I think in these companies usually we have usually less insider trading or proper accounting system, robust financial management and all, right? So these companies are there to stay for a long period of time. So usually these kind of examples might help in your career as well. So we are basically taking much more data from United States. Okay, so for internet content, if company is from the industry of internet content, its debt is just 2 and its equity is 90. So it's in increasing ratio. So as we move down, then its debt increases. So let us see, more than a little bit more than internet, there are steel companies. There is a steel industry. In the steel industry, there was average of 23.66% debt. Now you might ask, sir, why these companies opt to choose less debt, right? I think you might I think you can answer it as well after a lot of discussions and all. Usually these companies want to have less debt, other thing remaining constant, of course. So they want to have less debt because they want to increase earning before interest and tax profit for their shareholders. So as interest will be low, what happens? Your EBIT usually goes up, and as EBIT will go up, and then EBIT goes up, what happens? More dividend, more reinvestment, and more growth for the growth making companies. But one thing, earning per share also decreases if there is low debt. We understood that. But usually these companies are the ones which generate internally they generate internally revenue, so that their need for fund is already their need for fund is addressed by their general reserves. You see today as well, if you want to see companies, big companies like NTC, right? NTC and NLIC, these kind of companies have huge amount of reserve. Now if they want to invest in invest in capital budgeting project, do they need money first from debt holder or equity holders? They do not. No, definitely they do not. Have you heard NTC raising further public offer or IPO? I think IPO of NTC was raised much before, right? So rather than that, they usually do not go for fundraising. Why? Because they already have general reserve huge enough to fund their capital budgeting or any prospects. So usually these companies are those companies whose they might have huge amount of reserve. I'm just assuming. I may be right, I may be wrong. Please correct me if you know better. So usually when they have low debt, right? They usually they have good amount of equity as well, and maybe their internal revenue is huge. Next, pharmaceutical companies. The ratio is 35% debt and 65% equity. Petroleum, 23%. I think it's not in increasing order, you know. Petroleum 23, aerospace 55% debt, food processing 36. Like food processing means, for an example, chips manufacturing company, that is one example of food processing. Coca-Cola, they are also kind of food processing, right? Some primary product is converted into finished secondary product, which is consumable, and that is packaged and sold in the market. That is food processing. Next, railroads. Although railroads, yesterday in Nepal as well, a bill of rail is passed. So maybe rail, although it's in Jayanagar in Nepal, maybe we can also ride in train in our country. You know, so railroad 43%. Maybe industrialists will emerge to build more railroads in our country. So in terms of railroad, they usually take 43% debt and 57% equity. Next, airlines 51-49, electric goods 50-50. groceries 59.41, automobiles 42.68, and restaurant 96.4. Now you can see restaurant usually take huge amount of debt, and although it has been written 96%, usually 96% is it's kind of supervening impossibility in our country, because usually banks do not give them huge this much amount of money. But although but in outside firm they have this leverage, I think, for fund, they have access to capital. So one of the most cash rich business is restaurant. They have huge amount of cash flows, so maybe they can pay their interest through that cash flow. So they are taking huge amount of risk, that is leverage. So we can see a lot of turnover in restaurant as well. Higher the debt, higher the bankruptcy risk, right? So higher the higher the debt ratio, maybe these companies, restaurant, you can see opening and closing a lot of restaurants in the world, right? So maybe that is also one, I think, something we can take away. So these were the sectors we discussed, right? These were the industries we discussed where and their debt equity ratios. This slide is really important. You can go back if you want to open a certain industry. You can see industry average of US company of 100 years from here. So let us see some example. Alphabet Inc. Isn't this the company started by Steve Jobs? Alphabet Inc. I think it is the one. Alphabet Inc. When he was fired from Google, he started Alphabet, I guess. So Alphabet Inc. Its debt to equity ratio just 2%. It's already mature, right? No need to take much debt. So Alphabet Inc. had 2% debt. Nucor company 31. A lot of companies I have not heard. BP, Roxwell, Collins. You can search in Google if you want to know more about them. This is something I have heard. Southern Company. Ford Motor, of course, yes. 75. 20, huge amount of debt, in Ford. Wendy's means, I think they are, what are Wendy's? They might be food, burger companies or something like that.
Yeah, food. It's for food.
Food, right? Wendy's, yeah. Have you heard about Kroger, United Continental Holdings? I've not heard about them, CSX.
No, sir. Not heard.
No, I think you can do research as well in which sector these companies are. Definitely one thing is for sure, these are top companies of the world. Definitely they are from S&P 500. 100% they are from S&P, otherwise it would not be in data, right? Top 500 companies, S&P means top 500 companies of US. Okay, so these are company-wise debt equity holding examples, and these were industry-wise. So you can always come back and see. So you can observe in the slide there is another term called times interest earned ratio, isn't it? Times interest earned ratio. So what does this ratio means? This is very important ratio as well, right? So times interest earned ratio means how much your earning is there to cover your interest. How much earning is there to cover your interest? For example, Alphabet can cover its interest 218 times. So it has huge amount of profit. And I think it is just taking debt for the sake of taking debt. So higher the debt, what happens? Your times to interest on ratio will definitely be lower because your interest is rising. And definitely if you are taking huge amount of debt, what does it mean? It means that maybe your profit is definitely shrinking. So definitely in terms of Wendy's company, its times to interest on is 2.71. Its profit or its EBIT can cover its interest just by 2.71. And in terms of Alphabet, it was used. Let us take one middle one. If Rockwell Collins, its debt was 36 and its times to interest on is 13. Pretty well, right? Pretty well covered. So if it is more than 50, it's usually low. It's 7.62. So likewise, higher the ratio, better it is. Likewise, in case of internet companies where there is less amount of debt, huge amount of times interest on, and lowest in terms of restaurant, times interest on was 11.07. right? It definitely fluctuates. It's not like highest the debt, highest the times interest on. It is not that rule, because restaurant have huge amount of earning as well, right? They usually earn huge, so they might have a better earning before interest and tax as well to cover that interest. Got it? So better times interest on ratio, better, higher the times interest on ratio, better it is. Now this work demonstrates that the leverage ratios have drastically increased since World War II. After World War, what is happening? After World War II, after World War II, companies are taking a lot of debt in from the market. Okay, after World War II. So we have come to an end of this chapter. So let us summarize some concepts which we have learned, and if time remains, then let us solve one question as well I have brought for you. In this chapter, we examine the best way to finance assets. If you want to finance assets, if you have some capital budgeting decisions to make or new project on the pipeline, then definitely we are examining best way to finance them. More specifically, in this chapter, we examined the effects of financial leverage. We determined how interest affects a lot of other things, right? How financial leverage affects EPS, earning per share. The more debt you take, what happens? The EPS also increases. Share price also increases, right? Cost of capital decreases, but to the certain level of optimal capital mix, right? This is something we understood it. So debts are not bad for us, right? Debts definitely increase our earnings in the company, but to the certain level of that optimal mix. That is some biggest learning we learned from this chapter. The next one. In addition, different theories lead to different conclusions. Of course, everyone might have their own theory. What is meaning of life? And if I ask you guys question, then maybe Alex might have different meaning of life is to relax, but not to pay proper attention in the class. He might tell that, right? Or he might tell that, yeah, taking proper class attention to the class, that is meaning to life, and learning something new every day. Another one maybe even might say that meaning to life is being punctual in the class, right? Whatever, right? People might have different version. Being happy, being in the current state. So different theories. You can have your own theory of life. You can have own theory of finance as well, right? Maybe tomorrow you will promulgate one theory which might win Nobel Peace Prize, like Moulton, that theory, right? So different theories lead to different conclusions. Of course, different perception is already mixed, so it brings different conclusions. And about the optimal capital structure, and no one has been able to prove that one theory is better than others. Definitely we do not know, but knowing these theories, but please understand this, knowing these theories definitely facilitate us to understand our company better. Knowing these theories makes us better analyst. Knowing this theory makes us better analyzer of data coming from our own companies or companies where we work, right? So learning about past, learning about theories are really important. So next, therefore, we cannot estimate a firm's optimal capital structure. We cannot estimate from mind. We can find that range, right? 40, 50, 50, 60. But we cannot say as a hard and fast rule that, wait, if you are a restaurant, then your debt equity ratio must be 10 to 90. You cannot tell that. You have to take debt equity ratio out for each companies individually, and according to the custom based tailor-made information they have, and according to that only you can find that optimal capital structure. Financial executives generally treat optimal capital structure as a range for 40 to 50% debt. Usually it is a universal belief that 40 to 50% debt is ideal one, but maybe you can challenge them. Roman, Praveen, you can tell that, wait, this is 40-50 cannot be ideal, because in this situation, in this company, it is working. WACC is lowest. WACC is lowest when debt is 80% or 70%. If you tell that, you can definitely challenge it. But one universal concept is that, of course, 40 to 50% debt is idle one. So the concept discussed in this chapter are used as a guide, and they help managers understand factors to consider when they are setting target capital structure of their firm. Tomorrow, if you are going to start any venture, if you are confused, please go to the slides of this chapter, calculate your weighted average cost of capital, and find that ultimate mix, which will give you the lowest weighted average cost of capital, and that would be your ideal capital mix. That would be the ideal capital structure for you. Okay, so these are the summaries we learned from this chapter. I found this chapter really interesting, especially things which it can be how we can apply this in our personal life and in real life as well, and personally as well. If you want to build earnings of your as a personal finance as well, if you want to build your earnings, right, you can have a mix of debt and equity. It's not possible for you to add all the money from your pocket only in any venture. Always take debt as I would say necessary evil. It is definitely necessary evil, but we should not call it evil. That usually is an instrument, and it is the biggest kept secret from our society, that if you want to expand, if you want to grow more, you have to have debt or money of others, and then get huge amount of ROA or return. So with this, we come to an end of this chapter. Any confusion from these chapter, please let me know. It is the right time. And next class, we'll be solving questions, and we'll be also saying goodbyes to this chapter of capital structure. Anything you want to ask from this chapter? Do we have time for one question? I think this question will take around a huge question, this big one. So anything you want to share from this chapter? Any confusion? Any place where you felt like there is a gap in your understanding? Please don't shy off from asking it. Now you can go back to when you analyze balance sheets of companies. When you go to while you invest in any company, right? Now you have got new perspective as well, right? How risky this company is, right? So or why new company is raising its equity. You might want to suspect them. Maybe management's eyes, this company is not seen properly, right? That might be. Or it is difficult for them to reach capital from the loan market. So केही तपाईहरुलाई केही सोध्न छ यो च्याप्टरबाट?
No, sir.
Okay, all no confusion. I'm happy, teacher.
I think actually we have to run through it, obviously, but अहिलेसम्म चाहिँ no confusion.
Definitely. कसले भन्दियो? Either you explain it really well, or you did not explain it good at all. There is only two things to deduce. Again, no confusion on that. So, but also I'd like to be optimistic. Okay, so there is this question. I'll read it out, Oligiti. We have just 4-5 minutes. I don't think we can do it, but I can at least read it out so that you can be ready for next class. We'll be solving this in the next class and understanding it. Optimal capital structure. Now, this is our ultimate question from this chapter, right? Optimal capital structure. Now, this can be deduced for an other company as well. Optimal capital structure. Charles industry is trying to determine its optimal capital structure, which now consists of only common equity. Now it is 100% equity funded right now. This firm will add debt to its capital structure if it minimizes its weighted average cost of capital, but the firm has no plans to use preferred stock in its capital structure. So there is no preferred stock ko lafda, so no preferred stock at all. नेपालमा खासै प्रिफरेन्स स्टक हुँदैन, खासै छैन कन्सेप्ट, बाहिर चाहिँ हुन्छ, बाहिर त बोन्ड्स, डिभेन्चर, फ्युचर अप्सन, तपाईँको के हुन्छ हुन्छ, तपाईँको प्लेइङ विथ त्यो ट्रेजरी बन्डको पनि तपाईँको त्यो अब भनौँ न हाउसिङ लोनको मोर्गेज हैन, अनेक हुन्छ। नेपालमा पनि एउटा त्यो मैले अस्ति भनेको थिएँ तपाईँहरूलाई, जग्गाको त्यो युनिटहरू किन्ने बेच्ने भन्ने आउने भनेर भनिरहेको थियो। आई थिङ्क द्याट वुड हेल्प Nepal's economy. So moving on, but the firm has no plans to use preferred stock. Okay, so in addition, the firm size will remain the same. So funds obtained from debt issued will be used to repurchase stock. So they want to take loan from the market and repurchase their stock. Why would they want to do? Maybe अहिले रिसेसन चलिरहेको होला यसमा हैन, यति त बुझ्नुपर्छ है। अब यति पढिसकेपछि लोन लिने रे अनि शेयर they want to buy back its share. What does it mean? It simply means that अहिले शेयर एकदम सस्तो छ मार्केटमा अनि they want to take loan and buy back their share so that शेयर अहिले लिएर राख्ने, पछि भ्यालु बढेपछि फेरि इस्यु गर्ने, अनि त्यो ग्याप जुन हुन्छ उनीहरूले ग्याप चाहिँ लोन तिर्दिने, त्यसरी अनेक सोचे हुन्छ। The percentage of shares repurchased will be equal to the percentage of debt added to the firm's capital structure. Of course, in other words, जति एड गर्छ डेट त्यसले त इक्विटीलाई replace गर्छ. In other words, if firm's debt to capital structure ratios from 0 to 25, then 25% of shares outstanding will be repurchased. त्यो एक्जाम्पल थियो नि 10 जना रिटर्न र रिस्कको, त्यो 10 जनाले उठाइरहनु भएको त्यो भार हैन, 10 जनामा अब 10 जनामा 5 जना हिँड्नु भयो भने के हुन्छ, 5 जना मात्रै हुनुहुन्छ भने के भयो, 5 जना चाहिँ हिँड्नु भयो, 25% अब रिपर्चेज भनेपछि हैन, 5 जनामा हिँड्नु भयो, 5 जना चाहिँ रिटर्न अझै बढी रिटर्न आउँछ। लाइकवाइज यसमा नि 25% चाहिँ तपाईको जाने भयो बाहिर हैन, 25% जाने अनि त्यति चाहिँ डेट आउँछ। Its treasury staff has consulted with investor bankers. On the basis of those discussions, the staff has created the following table showing the firm's debt cost at different debt level. अब यो काम गर्ने कसले गर्छ यो काम गर्ने भनेको इन्भेस्टर बैंकरले निकाल्छ के यस्तो पोइन्टहरु, अनि इन्भेस्टर बैंकर मात्रै हैन, अब तपाईहरुले नि निकाल्नुहुन्छ यस्तो है, तपाईहरुले नि गर्न सक्नुहुन्छ। I hope so. So debt to capital 0 हुँदा, 25% debt हुँदा, 50% debt हुँदा र 75% debt हुँदा, डिफरेन्ट कन्डिसन्समा डेट हुँदाखेरि कति तपाईको कस्ट अफ डेट कति हुन्छ हैन, कस्ट अफ डेट एन्ड इक्विटी टु क्यापिटल रेशियो यो, अनि बन्डको रेटिङ यताउति it has been given. The firm has total capital of 5 million and 200,000 shares of common stock. Its EBIT is 500,000 and will not change if debt at any level shown in the table above is added to the firm's capital structure. Carlis uses the CAPM सुनि जस्तो लाग्यो होला तपाईलाई, capital asset pricing model to estimate its cost of common equity. Common equity को cost भनेको one of the most important formula CAPM, common equity को required return निकाल्ने, कति चाहिँ पैसा इक्विटी लाई चाहिन्छ, सरी रिटर्न इक्विटी लाई होल्डर लाई चाहिन्छ, very important. It estimates the risk free rate 33.5, premium पनि दिएको छ 4.5, tax rate 35 छ, बेटा दिएको छ भने निक्लिगयो। Calculate the firm's interest expense, net income, shares outstanding in EPS for each of the capital structures shown in table. हामी गर्छौं, भोलि गरौँला यसलाई, भोलि भन्नाले आउने Wednesday. At what capital structure is EPS maximized and what is the firm's EPS at this capital structure? Next, calculate the after tax cost of debt, beta, cost of equity, WCC for each capital structure. Consider only capital structure. अब जसरी घुमाएर सोधे पनि I think it will not be difficult for us to answer. Okay. So with this, we will solve this question about आउने Wednesday. Homework there at the camera saying you will not do it, I know that. कि त अब assignment दिन पर्यो. Okay. So I'll upload slides यसको capital structure को slides I'll upload it iLearn मा. You can go through it. And if you can, I'll also upload this question in iLearn. I'll not expect everyone to do it. I definitely will not, but I at least request I request all of you to do it, but I do not hope everyone will do it. एक दुईजनाले चाहिँ गर्नु होला है यो question. If you could solve it on your own, यो च्याप्टर फर्केर पनि हेर्न परेन आनन्दले त you have already understood it. If there are gaps, then please let me know. अर्कोचोटि म question solve गर्दा I'll definitely go to 1 2 address your query. Okay, so with this we have come to an end of the class. Again, giving you 30 seconds to share anything you want. 30 seconds, then I'll exit the class. Exit from the class. Anyone, anything you want to share? अहिले फाइनेन्शियल रिपोर्ट्सहरू कम्पनीहरूको आइरहेको छ नयाँ नयाँ है एभ्रीवन प्लिज जानु होला गो थ्रु इट स्पेसली इफ यु हेभ बट इफ यु हेभ इन्भेस्टेड अर इफ यु आर इन्ट्रेस्टेड इन एनी ब्याङ्क्स एन्ड इन्स्टिट्युसन्स देन डेफिनेटली प्लिज गो थ्रु इट अहिले आइरहेको छ सबै हाइड्रो पावरहरूको आइरहेको छ अहिले कुमारी ब्याङ्क पनि आयो क्या हिजो ओके सो विथ दिस I think nothing to share for now. So everyone, have a nice weekend. Stay. Bye bye.